Hey Joseph, welcome to Public.
Hey, Kyla, great to be back.
So I'm really excited to talk with you about the Fed meeting. The Fed decided to leave rates at their current level, basically hinting that they were going to cut rates this next year. Can you break down why the markets reacted so positively to this news?
Yeah, the markets kind of went crazy, right? It looks like they're taking off like a rocket ship. I think to understand what happened, we should level set a little bit to know how we got to where we are. So, the last time we had a Fed meeting, Chair Powell was basically talking about trying to figure out just how high he should take rates. He felt that the stance of monetary policy was restrictive, but he wasn't sure if they were sufficiently restrictive. But between then and now, a couple important things happened. First, we got inflation data that was better than expected. So disinflation is very much happening. And secondly, we had some really important Fed officials commenting that, hey, maybe we could, start to cut rates a little bit next year as inflation has cut down because we want to maintain real interest rates. Now, heading into yesterday's meeting, people were expecting some sort of dovishness because of that, and the market had been pricing in quite a bit of rate cuts next year. So Chair Powell definitely delivered on that in the sense that during the press conference, Chair Powell basically acknowledged that, on the committee, people are thinking that rates are we're basically at as high as we're going to be. And so that naturally leads to the next question. When are you going to start cutting? Now, we got some pretty good information about that from the Fed's dot plot. The dot plot is basically each FOMC member marking down where they think interest rates will be over the next few years. You get a really good sense of the committee's overall view on policy through that. Now, the dot plot, I think, was a bit more dovish than expected. The last time we got a dot plot was in September, and that dot plot marked two rate cuts next year, 2024. This dot plot, though, marked three rate cuts. So that was basically a shift towards more rate cuts. And the market, I think, looked at that, both that we're at, both the note that we're basically at max rate hikes, and also that we are going to be cutting a little bit more than we expected last time, and they just kind of went crazy. So markets really, really like rate cuts. When you cut rates, asset prices go higher, and that's what we're seeing right now.
Yeah, and it seems like the reason that the Federal Reserve penciled in some more rate cuts or appeared to be dovish was because of the inflation metrics that we've been getting recently. Do you think that these slower inflation numbers are the reason that the Fed has made these decisions? And do you believe that the decision to slow down and potentially cut rates is justified?
You're exactly right, Kyla. So in the dot plots, the Fed also showed what their projections for inflation were. So inflation so far for this year has been progressing better than expected. And so that's a big reason why the Fed has been willing to, I guess, pencil in more rate cuts. The way that the Fed looks at the world is through the lens of real interest rates. Real interest rates are nominal interest rates minus expected inflation. Now, from their perspective, since there's been more progress on inflation, naturally you should adjust policy a little bit to maintain real rates. Otherwise, you risk over tightening. So we'd have some very senior Fed officials, from Governor Waller to President Williams of the New York Fed, basically walk us through that the past few months. So according to that framework, yeah, that what they're doing makes total sense. Now, there's always a risk, though, that what if you cut interest rates and then inflation comes back? So right now, when we cut interest rates, we can see the stock market basically at all-time highs. If you look at things like house prices, well, they've been trending higher, and maybe when mortgage rates come down, they will continue to soar higher like they did in 2021. So maybe that might eventually have some inflationary impact. I think that's a tough call right now. So it could be, especially since the economy is doing well, household balance sheets are well, that we cut rates and we have inflation reemerge. But that's something we'll find out in 2024.
Yeah, that was one interesting thing about the press conference yesterday is Jerome Powell was like, you would think that it gets harder to fight inflation, but it hasn't gotten harder. They've been able to kind of keep on doing what they're doing and inflation has gone down. Do you think that the fight against inflation has primarily been action from the Fed, or do you think it's more normalization of supply and demand?
Honestly, so Let's be fair to the Fed, though. Some things in the economy are really interest rate sensitive, and the Fed controls, well, okay, tries to manage inflation through interest rates. So the Fed's actions did have some impact on the economy. Housing, for example, when mortgage rates were below 3%, obviously home prices were soaring. When the Fed began to raise interest rates, we saw moderation, significant moderation in the housing sector. So that part, I think, is squarely within the Fed. But in a lot of other aspects of the economy, it's a lot less clear what the Fed did. I think to better understand this, we should rewind a bit to think about what happened last year at Jackson Hole. Last year at Jackson Hole, the Fed Chair Powell went on stage and said that he's going to hike interest rates aggressively, and there's going to be some pain. So he was thinking that high interest rates would lead into an economic recession, would raise the unemployment rate, get wage growth down, and then get inflation down. But now looking forward, looking back with the benefit of hindsight, none of that happened. So he raised interest rates really aggressively, economic growth solidly above potential growth this past year. In fact, in quarter three, we were growing about 5.2%, which is bonkers. And at the same time, the unemployment rate remained around record lows. So, the Fed hiked interest rates thinking would do something. None of really what they thought would happen did happen. It seemed like they lucked out a bit. In Chair Powell's conference yesterday, he mentioned improving supplies, as you noted, Kyla. So one is that we have labor participation increase, so more people joining the labor force. We also had immigration resume to the rate that it was pre-pandemic. So this increase in supply of labor helped to moderate wage gains without increasing unemployment. And of course, globally, we do have improving supply chains. And so that all helped to moderate inflation. So for most of inflation, I'm not sure the Fed did anything, but for interest rate sensitive stuff like housing, I think the Fed played a big role there. And now they're reversing. Maybe we'll see housing inflation go back up again.
Yeah. And it's interesting because Jerome Powell shifted his stance quite a bit over the past 2 weeks. So December 1st, he said it would be premature to speculate on when policy might ease. And then, of course, yesterday he was like rate cuts or something that begins to come into view, clearly a topic of discussion. What do you think happened over those 2 weeks? Was it primarily the inflation prints that we've been getting, or do you think it was something different that shifted Powell's view?
I don't think it was the data. So the inflation, the CPI print we got was basically on the screws. It was on expectations. The labor market report, the non-farm payroll report, was a bit better than expected, actually. So I actually think that what happened yesterday was Chair Powell got overwhelmed by everyone else on the committee. My sense, and he commented on this a few times, is that, so we have the dot plot yesterday during the last meeting. And for the dot plot, what happens is that every Fed official basically submits their forecast and it gets tabulated and published. So Chair Powell doesn't seem to have a lot of control of what people say on their dot plot. He definitely lobbies a lot to make sure that everyone is on the same page at the conference so that there are no dissents. They've always been like that. They don't like to have dissents. But I think when it comes to the dot plot, he has a lot less control. And my sense is that there's a lot more people on the committee who are more dovish than Chair Powell. And so even though maybe Chair Powell himself hasn't changed his stance, there's just so many other people there who have, and that's showing up in the dot plot. And the dot plot, I think, was one of the primary reasons why yesterday's conference was interpreted as dovish. So in a sense, I think he's being overruled.
Yeah. And not to microanalyze Jerome Powell, because a lot of people already do that, but what do you think his tone was regarding the Fed policy stance? Do you think it was one of cautious optimism, or would you describe it as being overwhelmed, as being like, well, kind of have to say this because everyone else is?
So I thought that, yes, the conference was a bit awkward. So there was a lot of people who pointedly asked him about the easing in financial conditions, and he didn't. I felt that he kind of just sidestepped that. And personally, he always added the commentary that the committee is prepared to continue to raise interest rates if they feel necessary and so forth. But that's kind of commentary that you can't find in the dot plots. It's something that he adds himself. And like you mentioned, he looking solely at him, it would be a big shift if he suddenly changed his mind over the span of 2 weeks. So I think it's him acknowledging that the committee as a whole is viewing things, has changed how they view things. And another way you can see this is through how the dispersion of the longer run neutral rate in the dot plots. So the neutral rate, the longer run neutral rate is where Fed officials think that over the long term, the policy rate would be. Now, over the past couple of years, that neutral rate has kind of skewed a little bit higher. And that is because that we had significant inflation, and there were some people on the committee beginning to think that maybe there were some structural changes in how the world works, so that going forward, the neutral rate would be higher, interest rates would have to be structurally higher. In the dot plot we got on the last meeting, those guys seem to have changed their mind. So you saw the dispersion of the neutral rate come back to where it was in the past. So again, there seems to be a shift on the committee as to how the world works and on their policy stance. So if you think that the neutral rate is actually lower than you thought before, then naturally you have to adjust your interest rate expectations lower as well.
What should investors think about the idea that nobody knows what the neutral rate really is? Jerome Powell sort of said that directly yesterday. Like, how should people think about that?
So if you have, so the neutral rate basically is a standard by which you judge the stance of monetary policy. If your policy rate is above neutral, then you're being restrictive. If your policy rate is below neutral, then you're being accommodative. So the way that I think about it is that if your neutral rate has been adjusted lower, then what's happening is that you are actually more restrictive than you thought you were. And so you have to get back down you have to adjust rates back down to where you originally thought you were. So I think that's part of the reason why the market has interpreted this message so dovishly. So basically, there are some people on the Fed who are being more restrictive than they wanted to, and so they're adjusting lower now. So that's how I would think about it.
And it seems like markets are, of course, taking everything to the extreme, and you see like certain types of cryptocurrency skyrocketing again. Do you think that we're going to go back to sort of a zero interest rate party phenomenon, or do you think that will remain sort of restrictive for a while?
So I actually think that this is tremendously positive for financial assets. So on the one hand, I think a big driver for inflation and asset prices over the past few years was fiscal policy. We've all talked about that. But I think what's less obvious is that fiscal policy continues to remain very loose. So our deficit right now is about 7%. And as many commentators have noted, that's unheard of in an economy which has record low unemployment and growth above trend. So fiscal policy remains loose, and monetary policy is also, they won't say easing, but interest rates are declining. And so I think that's a very, very strong combination for asset prices. And we could continue to see surges in crypto, surges in house prices, surges in equity prices, as we saw before. Now, the question is, of course, as we noted earlier, does this surge in asset prices bring back inflation such that rates might have to either stay where they are or get increased a bit? Now, I definitely don't think that we're going back to zero bound because, well, there's really no reason why the economy continues to perform above trend growth, and inflation is still above the Fed's target. So there's no reason to go back to zero. The question right now is whether or not we stay here for a while or maybe even raise a little bit because inflation comes back. The market right now is pricing in significant amounts of cuts. I think almost 6 cuts next year. My sense is that the more cuts you price in, the less likely that actually happens, because when you cut rates, when you price in so many cuts, you actually stimulate the economy. And so you make it less likely that there actually will be cuts.
And do you think that inflation could come back? You've said that a couple of times now, so I'm just curious.
So like we discussed earlier, when you cut rates, you have an uneven impact on the economy. Some sectors are very interest rate sensitive and they're going to zoom. Some other sectors are not as interest rate sensitive and maybe they won't be as impacted by it. So what I think going forward is that you're going to see some sectors like housing where house prices continue to increase, but other sectors maybe not so much inflation. For example, looking at commodities. So commodities are a global market. And when you look across the world, you have recession in Eurozone, recession in China. And so there's not going to be as much demand for commodities globally. And so it's unlikely that commodity prices would surge. So for those aspects of the economy, I don't think you see much inflation. So it's going to be an uneven picture going forward, I think. And with how the Fed reacts to that is something we'll have to see.
And the Fed has also, another tool just beyond cutting rates, their balance sheet. What insight did the Fed provide to what they're going to do with their balance sheet?
Yeah. So the last question Jerome Powell fielded before he kind of rushed off stage was on quantitative tightening. So quantitative tightening is when the Fed shrinks their balance sheet. Now, what we've been doing over the past couple of years is that we've been hiking rates and shrinking the balance sheet. These are the two tools the Fed uses to conduct monetary policy, the policy rate and their balance sheet. And historically, these two tools go in the same direction. So when we're hiking rates, that's restricting policy. And when we're shrinking the balance sheet, that's also restrictive policy as well. So the thinking is that you don't want to be stepping on the gas and the brakes at the same time. So you always want these two tools to be going on the same direction. But what Chair Powell seemed to be open to is allowing the balance sheet to continue to shrink, so QT to continue even as they cut rates. His view was that because we're cutting rates, not because the economy is in trouble, but because inflation is coming down, in a sense, we're just normalizing interest rate policy. So in that same vein, we could just continue QT to normalize the balance sheet. I think that was the key takeaway from that conversation. So going forward, I would expect QT to continue throughout the next year, even after we have had a few cuts, until, of course, we really do get into a recession.
Yeah. Do you imagine a 2024 recession?
Well, recession is always coming. It's like death and taxes. It's unavoidable. But so my thinking a month ago, as we saw longer dated interest rates rise significantly, it was that we would probably have a recession sometime in the second half of next year. After all, it takes some time for those higher interest rates to feed into the economy. So right now, though, I'm thinking that that's getting pushed away, because as we cut rates, as the market zooms higher, people have more wealth and borrowing costs become lower. With more wealth and lower borrowing costs, it seems like that's a big boost to the economy, such that the probability of a recession next year decreases.
Yeah.
Again, this is very fluid, but at the moment, looking at what I see in markets, it seems like the market is basically boosting the economy a bit.
Yeah. And I think 2024 is going to be interesting because it's almost a maintenance year because of the election. Do you see things just sort of cruising along because nobody wants to disrupt that vote?
When Chair Powell was asked about that, he was quite firm that he does what he thinks, the committee does what they think is best without regard to an election year or not. I think if you look at the Fed's history, that's true. That when the conditions demand, I think that they will not, that election will not affect their calculation. So I think I would downplay that.
What's your base case going into 2024 as we look into the next Fed meeting?
So I think the Fed's dot plots are a pretty good estimate. So right now, the dot plot suggests 3 rate cuts next year. The market is pricing in almost 6. So there's some reflexivity to this. When the market is pricing a lot of rate cuts, financial conditions ease. And so paradoxically, you'll need fewer actual cuts because the economy is doing well. So I think that 3 cuts next year in line with declining inflation makes a lot of sense. But I suspect that we're going to stall in our progress on inflation. On the one hand, the deficit remains very large. And on the other hand, I think we'll have sectors in the economy that begin to overheat as interest rates have come down. And I think that's going to limit the number of cuts we get next year. But it will also suggest that economic growth will be better than forecast right now.
Amazing. Well, thank you, Joseph. Yeah, Joseph, this has been a great conversation. Where can people find your work?
Oh, thanks so much for having me. If you're interested in following me, check out my website, fedguy.com. And of course, you can find me on Twitter at fedguy12.